Okay, welcome to part two of our three-part Mindful Money Investing series. The first part was a discussion of the things you should do before you invest. Today, we're going to talk about the specifics of investing, building a portfolio, putting the money to work within the portfolio, and some bit about investment selection. Our final Mindful Money Investing segment will be a discussion of what you can expect after you invest. It'll be part psychology and expectation, and part how to add more money and manage a portfolio once you are investing. Take notes, write down your questions so you can ask them at the end here if we have time, or via social media channels when it's all over. And remember, this is general information and education. Everyone's situation is different. This should not be seen as specific recommendations. Think about what you learned today, and then before you act, ask some questions and get more specific answers suited to you. All financial decisions involve trade-offs, and all investing involves some kind of risk. Today, we'll build on what we learned in our Before You Invest session. If you remember, just looking back, we learned first that we are hardwired to make financial mistakes, partially because we've never learned anything practical about money, partially because of our inherited money stories, and partially because there's an emotional context to our financial decisions that both the financial media and Wall Street understand. And second, we discussed a personal finance order of operations. First and foremost, we have to get into the habit of savings. And once we get into the habit of savings, we have to have some idea of what our life is supposed to unfold like. We have to do some planning. Then we have to fully fund our emergency plan. We have to consider the appropriate risk management tools, different types of insurances. And then finally, before we invest, we have to start paying down some of those high interest debt loads. Okay, now why are you here? Are you looking for the easy way to wealth, or are you hoping for an exciting investment opportunity to help you make more money right now? If so, I'm going to tell you, you're in the wrong place. Building wealth is not a sprint. There is no get rich quick. It starts by saving a single dollar and ends with an asset base that spins off an income you can't outlive and that you can leave to next generation. If you're here because you want to get smarter about money, make better investment decisions, enjoy better financial outcomes, and do it in a way that lessens stress and anxiety, then stick around. We're going to talk specifically about creating a process that should prepare you for a lifetime of investing without piling stress and anxiety onto the other parts of your life. Mankind, especially here in the United States, but increasingly everywhere on the globe, has made a secular religion out of investing, and the pursuit of outperformance has become the end-all, be-all of personal financial goals. The assumption seems to be that if you just outperformed all your neighbors, your hopes and dreams would all become realities. I really hope you see the disconnect here. Every time I hear myself say, if you outperform your neighbors, your dreams will become true, it just sounds stupid. It sounds grotesque. That's because it is stupid and grotesque. We're going to make it simpler. We're going to create better, less stressful outcomes, and we're going to let you focus on the things that really make you happy. Now, many people think that investing is a one-off decision to buy this or that security right now, or a series of unrelated decisions. I buy this and sell that, buy this, and I just repeat this until I'm successful. Remember, there are two basic belief systems in the personal finance world. One claims knowledge and optimizes on that knowledge, while the other rests calmly in humility and optimizes on that humility. Today, we're going to talk about the latter, optimizing on humility, but let's start by describing the former. Knowledge claimers rely on prediction, impulse, tips and hunches, and media pundits to tell them what to do. All the research done on investing tells us that no one can consistently or predictably optimize portfolios on knowledge. In other words, the market is too efficient to allow for a persistent information advantage. This idea, the efficiency of markets, turns out to be very, very important to investing. Yet, the secular religion of performance absolutely rules financial product manufacturing and financial media. They all talk a good game, but the vast majority of those who aim at outperforming underperform over periods of time that actually matter to us. We're here today to talk about a better way, optimizing on humility. We cannot control the media or Wall Street, but we can absolutely control how they affect us. We can review the facts and the research. We can educate ourselves as to which decisions matter, and we can step out of the culture that drives us to claim knowledge where none can actually be had. Through humility, we can access better outcomes, both financially and personally. Now, we closed our part 1 before you invest session with these 3 character traits. And we want to open this session with them because these are the character traits required for an investor to successfully rest in the humility of not knowing. First, faith. One cannot endeavor a financial plan or undertake an investment without a fundamental faith in the future. When things are going incredibly well, they will break. When they are broken, they will be fixed. We will not know how or when. No one else will either. Understanding that your portfolio will spend months, maybe years, underperforming some other portfolios and indices and outperforming other portfolios and indices to different degrees at unpredictable times and not changing direction is an expression of your faith in your plan. Knowing that different pieces of your portfolio will act differently when met with changing economic stimuli and not selling your losers to chase the dream is an expression of your faith in the investment process. Once you've planned and implemented an appropriate portfolio, don't second guess it based on performance. What others are experiencing has nothing to do with you. Believing in your plan is not just a good idea, it is critical to its very success. Second, patience. We're asking our investments to produce for us 20, 30, 50, or more years into the future. We really don't need to be concerned about what happens this month or this year. Faith and patience, I hope you can see this, work together. One must certainly have faith that things will be okay, but one must also recognize that they won't always be okay, and then have the patience for them to turn around. Remember the Great Recession, 2007 to 2009? We got through it. Markets and investments, if you stuck with them, are at new highs. In 2008, it was the end of capitalism as we knew it. By 2010, it was business as usual. This, too, shall pass. It always does. Finally, discipline. Discipline is the iron wire upon which all of our principles are strung. Saving first is a discipline. Staying invested in dark times is a discipline. Continuing to fund that plan month in and month out, regardless of whether the market's moving up or down, is a discipline. And while you're being disciplined, there will be no shortage of people trying to steer you off course. Media and Wall Street will always have a warning or a new shiny object to sell you. Ignoring them is a discipline. Those who claim knowledge where none is possible get the headlines. The people who humbly stick with their plan with faith, patience, and discipline will always get the outcomes. Many investors have unfulfilled expectations. They're looking for a better solution, one that can lead to a better investment experience. What would that approach look like? How can they improve their odds of success? We want to start by looking at some investing fundamentals. What is investing? Some of you may associate investing with speculating, gambling on the volatile or uncertain value of assets in the hope of obtaining potentially higher returns. Others may see investing as more of a long-term methodical effort of saving for the future. In fact, investing is a little bit of both. All investing involves a certain amount of risk, including the potential of loss of principal. And there can be no ironclad guarantee that any investing strategy will be successful. Investing also involves, and this is a good part, the potential growth of your money over time. We consider investing a carefully planned and prepared approach to managing and accumulating money. It's not about picking the best stock. It's about a process that balances risk and return appropriate to you. It's about discipline and patience. It doesn't have to be overly complex. The most important thing, or most important concept to understand when it comes to investing is the difference between money and currency. If you have a $10 bill, then today you can buy a good worth $10. In a year, it'll take $10.30 to buy that same good. In 10 years, it'll cost a little bit more than $13.50 for the same good. In 30 years, this is roughly the length of a retirement, the same item will cost you nearly $25. That is 2.5 times more for the same good. Currency, that $10 bill or whatever the cash is in your pocket, does not hold its value over time. This is the impact of inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. According to the U.S. Department of Labor, the average annual rate of inflation since 1914 has been roughly 3%. At 3% annual inflation, something that costs $100 today will cost $181 in 20 years. So let's just say real quick that you have $200,000 stashed in your mattress. If you assume the 3% average annual inflation, that $200,000 will buy you just over $108,000 worth of goods and services in 20 years, and less than $60,000 in 40. This means that if your investments aren't keeping pace with inflation, you're actually losing purchasing power every year. You may have more currency, but you will have less money. It makes no sense to protect your currency by sacrificing your purchasing power. This will be important to recall when we start talking about stock investing. If inflation is 3%, then you have to make 3% on your money just to break even. Now, I don't want to put too fine a point on it, but consider the simple cost of milk. In 1913, 9 cents would buy a quart of milk. 50 years later, 9 cents would buy a small glass of milk. More than 100 years later, 9 cents was only going to buy about 6 tablespoons of milk. And this isn't even the good organic stuff. Over a lifetime of investing, the most important thing you can do, not can do, but must do, the most important thing you must do is preserve and increase your purchasing power. If inflation has the general effect of reducing the real value of your investments over time, compounding has exactly the opposite effect. Anyone who has a savings account understands the basics of compounding. The funds in your savings account earn interest, and that interest is added to your account balance. The next time interest is calculated, it's based on the increased value of your account. In effect, you earn interest on your interest. Many people don't fully appreciate the impact that compounded earnings can have over long periods of time. Let's look. Let's say you invest $5,000 a year for 30 years. After 30 years, you'll have invested a total of $150,000. Yet assuming your funds grow at 6% a year, because of compounding, after 30 years, you'll have over $395,000. Now, my mom and dad always told me that compounding was the 8th wonder of the world, and this is why. You put 150 in, you get 395 out because of compounding. Okay. The sooner you start investing, the more time your investments have for compounding. Wait too long, and it makes it very difficult to catch up. For example, invest $3,000 at the end of each year, starting when you're 20 years old, as a personal IRA maybe, and you'll have accumulated almost $680,000, assuming a 6% annual growth rate and no tax by age 66. If you wait to start until 35 and do the same $3,000, you'll accumulate about $254. Notice that's less than half. And if you wait until 45 to start, you accumulate only about $120,000, a very small percentage of what you had as an opportunity if you started earlier. It's never too late, so I don't want to discourage you. I'm simply trying to illustrate the importance of starting today if you haven't already started. Remember, though, all investments take risk. Seriously consider how much risk you can handle, or volatility. The world of investing is very subjective. The investment plan that's right for you depends largely upon the level of comfort that you have when it comes to volatility. As we've seen, you cannot avoid the zigs and zags of markets. If you don't put your currency at risk by investing, then you put your purchasing power at risk to inflation. The key is taking appropriate risk to your desired plan outcomes and then sticking to your plan. There are 2 aspects of risk tolerance to consider. First, the capacity of your investment plan itself to absorb losses, and second, how comfortable you are personally with risk. The first aspect can be quantified. The more flexibility your investment plan has when it comes to potential loss, the more risk your plan can tolerate. For example, a long investment time horizon may allow you to take on more risk than a short time horizon because you have time to recover if something does go wrong. Remember, 2008 was horrible, but markets had largely recovered those horrible losses in 2 or 3 years. Patience works. The second aspect, how comfortable you are personally with volatility, is more of an emotional measure and depends on many factors, including your objectives, your life stage, personality, investment experience. Some investors are comfortable with lots of volatility, while others can tolerate only minimal amounts. Your individual risk tolerance is an important factor in deciding your investments, because the worst thing you can do is select an investment process you can't stick with when portfolio experiences trouble. If you panic and sell at the wrong time, you give up on your plan and your desired outcomes. Same is true if you get overly excited and buy the wrong thing at the wrong time. A steadier approach is better because it can help us avoid making bad decisions. And we often hear people say, yes, but investing is so risky. And I always want to remind them that not investing is risky too. If you don't grow your money, you may not be able to afford things in the future. To understand investing, we have to know what our choices actually are. What is it that we can actually put money into and invest in? When it comes to investing, there's a direct relationship between volatility and return. That is, in general, as the potential for return increases, so does the amount it will zig and zag. Or, stated another way, the less volatility an investment has, the lower the potential for return. So, for example, putting your money into a bank CD may have little risk, but it also offers less potential for return than purchasing a common stock. This is true for investment portfolios as well as for individual investments. The more aggressive you are as an investor, the more volatility you may be willing to endure. More volatility means a greater potential return, but also a greater chance of loss. Conversely, the more conservative you are as an investor, the less volatility you're generally comfortable with. Less volatility means lower potential return, but less likelihood of loss as well. This is the risk-return trade-off. All we're saying here is that risk and return are two sides of the same coin. As much as we would like it, we can't have it all. There is a relationship between growth, income, and the stability of our investments. And when we move closer to one, we automatically move away from the other. This is the dilemma that all investors face. The key is to set the right level of risk to fulfill your plan and maximize returns at that level of risk. There are several general categories of investments to choose from, and countless specific investment options within each category. Today, we're going to discuss cash, bonds, stock, and some number of other investments, but only briefly. Cash alternatives are relatively low risk, short-term, and generally fairly liquid. In other words, you can convert them to cash quickly if needed. You might use cash alternatives for safety and liquidity. This is where your emergency fund will be invested. And maybe you'll use cash to serve as a temporary parking place for assets until you decide where you want to put them long term. The downside of cash is its low relative return compared to other options. And the returns on cash may not even keep up with inflation. A few examples of some cash alternatives include simple savings, CDs, money markets, treasury bills, also called T-bills, and each of these options offers different rates of return and varying levels of liquidity and safety. Bonds are essentially loans, which is why they're called debt instruments. You, the investor, lend money to a government or corporation. The interest rate or coupon rate is set in advance, and interest payments are generally paid semi-annually. Bonds are issued in denominations as low as $1,000. In addition to set interest rate, the maturity date is fixed, ranging from 1 maybe to 30 years. However, bonds don't need to be held until they mature. Once issued, they can be traded among investors like any other type of security. Because you can buy or sell bonds in the open market, bonds fluctuate in price, selling at, above, or below their face value. If interest rates rise, new bonds and investment options are offered with higher interest rates, and existing bonds with lower fixed interest rates become less appealing. So, when interest rates rise, existing bonds generally decrease in value. In contrast, when interest rates fall, existing bonds generally increase in value. The longer a bond's duration to maturity, the more volatile its price swings. From a portfolio perspective, bonds are more volatile than cash, pay a bit higher rate of interest, and their value fluctuates differently than stocks. It's another way of saying they're non-correlated. so they are very good additives to reduce overall portfolio volatility. Now, stocks. When you buy company stock, you're actually purchasing a share of ownership in business. The greater the number of shares you own, the higher the percentage of ownership you have in that company. Investors who purchase stock are known as the company's stockholders or shareholders. Your percentage of ownership in a company also represents your share of the risks taken and profits generated by that company. If the company does well, your share of the total earnings will be proportionate to how much of the company's stock you own. The flip side, of course, is that your share of any loss will be similarly proportionate to your percentage of ownership, though you are never personally financially responsible for any share of the liabilities of the company in which you hold an equity interest. In other words, you're never going to have to pay any of their debts back. Your risk is limited to the investment you have in their stock. Beyond that, depending on the company and the types of shares you have, stock ownership may carry other benefits. Specifically, you may be entitled to dividend payments, capital gains payouts, and the right to vote for candidates for the board of directors and on other issues. If you purchase stock, you can make money in one of two ways. First, earnings can be distributed in the form of dividends, usually paid quarterly. Second, you can sell your shares. And if the value of the company's stock is increased since you purchased it, you make a profit. Of course, if the value of the stock has declined, you make a loss. Stocks come in many shapes and sizes. They're often categorized by the market value of the company that issues the stock. For example, very large companies, Apple, Exxon, General Motors, are considered large cap stocks. Smaller companies fall in the mid cap, small cap, or micro cap categories. This kind of makes sense. Stocks can also be classified according to the characteristics of the company itself. For example, growth stocks are usually characterized by earnings that are increasing at a faster rate than their industry average or the overall market. These are often in new, fast-growing industries. Think, 3D printing, electric cars, social media. Value stocks are typically characterized by selling at a low multiple of a company's sales, earnings, or book value. They may offer higher dividend yields than market averages and are typically found in stable, well-established industries. Cash, bonds, and stock are the three major investment categories, but there are many other options, including real estate, commodities like gold, sugar, wheat, corn, and collectibles, such as maybe antiques, art. We're not going to spend much time talking on these other investments. Stocks, bonds, and cash are the building blocks of every portfolio. Some people buy them directly, some hire a manager or managers, and many people will buy an index or indices. You can even blend these three methods. Hire a couple managers and invest in an index. And still, at the end of the day, your portfolio will be made up of a blend of stocks, bonds, and cash. Each of which behaves differently. Most look to these markets as their main investment avenue, and they have been rewarded long-term with returns that outpace inflation. This is documented in the growth of wealth graph we see here, which shows monthly performance of various indices and inflation since 1926. These indices represent different areas of the financial market, such as stocks and bonds. The data illustrates the beneficial role of stocks in creating real wealth over time, and it illustrates the different zigs and zags one can expect from the different types of investments. T-bills have barely covered inflation, while long-term bonds have provided higher returns over inflation. Stock returns have far exceeded inflation and have significantly outperformed bonds, but they've done it, you can see on this chart, with a lot more volatility. Over this time period, the title goes to small caps. $1 invested in small cap stocks in 1926 would be worth more than $18,000 today. Keep in mind that there's risk and uncertainty in the markets, and that historical results may not be repeated in the future. History is a fantastic long-term guide, but it doesn't enable us to make any type of short-term prediction. So how do people do it? Most people claim knowledge. They try and time markets and select new investments based on prediction, impulse, tips, hunches, and pundits. The research tells us that these methods lead to unreliable outcomes. And why do people insist on doing it? Fear and greed, for sure, but I think the biggie is culture. Everything in the way we talk about investing and advertise investments and think about markets leads us to want to be better market timers and gives us the desire to select the best investments, when neither of these is consistently possible. The academic research tells us that timing and selection account for less than 10% of an investor's lifetime outcomes. There is no persistent information advantage, and no one has predictably and reliably optimized on knowledge ever. Thankfully, we don't need superior knowledge. We are happy optimizing on humility. And this is why. The average investor experience can be summed up in this chart. Dalbar Inc. has done this study every year for 20 years. And every year for 20 years, Dalbar has looked at the prior 20 years and discovered that the average investor has given up roughly 2/3 of the performance of the very markets they're invested in and has barely beaten inflation. In our culture, which has made a virtual religion out of outperformance through superior timing and selection, the returns of the average investor, again, trying to time and select, pale in comparison to the very markets they're invested in. What's more, other research shows that the investors are actually underperforming their very own managers, the ones they're selecting. How can this be? How can the average investor underperform this much? The only possible difference could be poor behavior, poor timing and selection. They buy the wrong thing at the wrong time for the wrong reason and sell the wrong thing at the wrong time for the wrong reason. But why does it happen? What causes this? Well, the very first reason is performance chasing. Some investors use recent past performance as a guide to selecting investments, reasoning that a manager's past outperformance is likely to continue in the future. Does this assumption pay off? Research says no. The chart illustrates the lack of persistence in outperformance among U.S. equity managers. The managers are evaluated based on their 10-year track records, 2000 to 2009. And those that beat their respective benchmarks are reevaluated in the subsequent 5-year period. Among the 2,711 equity managers, only 682 could fall in that top quartile, the top 25% that outperformed. Of that 682, only about 25% of them stayed in the top, actually 28%, stayed in the top for the next 5 years. Looks pretty random to me. Some U.S. equity fund managers may be better than others. It cannot be identified in advance. Returns contain a lot of noise, and impressive track records often result from good luck. The assumption that past performance will continue often proves faulty and leaves many investors disappointed. Performance chasing is a big contributor to our general underperformance. And many people concentrate their investments in their home stock markets. They choose only U.S. investments and consider their portfolio diversified. In some cases, they only hold a small group of securities within that home market. Yet, from a global perspective, limiting one's investments universe to a handful of stocks or even one whole market is a concentrated strategy with possible risk and return implications. In my opinion, concentration gives us a small possibility of greater short-term returns. However, it comes with increased volatility in both directions, up and down, and a lower probability of achieving our desired planned outcomes. This slide offers a conceptual comparison of investing only in the U.S. market, as represented by the S&P 500 index, so 500 companies, and structuring a globally diversified portfolio that holds assets in markets around the world, as represented here by the MSCI All Country World Index. For the global portfolio, it holds 8,600 companies in 46 countries and broadens one's investment opportunity while minimizing the risk that a single company can do us any real harm. Stock ownership opportunities are available in markets around the world. This cartogram depicts the world not according to land mass, but by the size of each country's stock market relative to the world's total market value. Of course, the world is in motion. There's no fixed relationship between markets, and their proportion can change over time. Viewing the world by relative equity market capitalization illustrates the opportunity to invest through a globally diversified portfolio. This is also true of opportunities in the global fixed income markets. Investors can go beyond the US to participate in the expected reward potential in other countries and their economies. This cartogram shows the balance of the investment-grade fixed income opportunities around the world, with the size of each country adjusted to reflect the relative size of its bond market. This is how people should think about their investment opportunity set. Investing is about forming an approach for holding stocks and bonds around the globe and participating in the expected reward potential over time. Even with a globally diversified portfolio, market movements can tempt investors to switch asset classes based on predictions of future performance. But as shown in this table, there is little predictability in asset class performance from one year to the next. This slide features annual ranked performance of major asset classes in the US and international markets for the 15 years from 2000 through 2014. The asset classes are represented by corresponding market indices. The data shows no obvious pattern of performance across asset classes, suggesting that predicting future performance is at least a difficult task. The charts offer additional evidence of market efficiency and make a strong case for investors to rely on portfolio structure rather than market timing to pursue returns. So that's what not to do. Is there a better way? Obviously, I think there is, or why would I be here? I believe there is a way that can put the odds of success in your favor. It starts by considering what academic research has revealed about markets and investing over the past 60 years. One can then build an approach based on decades of research into the financial markets, including pricing dynamics and the behavior of different areas of the market. It starts with believing market efficiency and trusting market prices. The academic community offers a wealth of insight into how markets work and the sources of expected returns. This timeline offers some of the high points in the evolution of modern finance. One driving principle is that markets work. That is, market prices reflect all available information and expectations of the future. This is known as the efficient market hypothesis, or EMH for short. The forces of supply and demand are constantly at work in the financial markets, and the intense competition pushes stock and bond prices toward their actual value. People trust markets every day. For example, when shopping, you probably don't question whether the price of an item is right or wrong. You simply assume the price reflects local market conditions. You might decide the price is too high and choose not to buy it. And if enough people agree with you and don't buy the item, the price will drop. That is how markets work. Yet, many people's perception of market pricing breaks down when they invest because they assume that the price of a stock or a bond may not be right. They're conditioned to view some stocks as being overvalued and others as being undervalued. Just think about today's Yahoo headlines or the cover of any financial publication, and you'll see this at work. In reality, the financial markets work much like any other market, with information and opinions affecting the price of a stock or a bond. That price reflects the aggregate view of what the investment is worth and at that moment in time. The forces of supply and demand push prices towards market equilibrium, and those forces are at work in the financial markets. So let's just illustrate this concept with an example of how collective knowledge can come together and be more powerful than the knowledge of any one person. At a client event hosted by a fellow advisor and friend, a jar of jelly beans was placed in the lobby and attendees were asked to estimate the number of jelly beans it contained. The participants wrote down their estimates, and whoever offered the closest estimate to the actual account received a prize. There was a wide range of estimates, 409 to 5,365 jelly beans. The average of all the estimates was 1,653. The actual count, 1,670. Now, I've seen the same experiment work with fourth graders at my son's school. The principle is that the combined intelligence of a group is better than the knowledge of one person. The crazy outliers and guesses on either end tend to average each other out. Together, we know more than we do alone. So consider how this aggregation of knowledge and opinions works in the financial markets. Millions of participants buy and sell securities around the world. In the US markets alone, investors trade billions of dollars in stocks and bonds each day. The new information buyers and sellers bring to the market helps set prices, and with each bit of new information, prices adjust accordingly. No one knows what the next bit of new information will be, as the future is uncertain. but we can accept current prices as fair. This doesn't mean that a price is always right, because there's no way to prove that. But investors can accept the market price as the best estimate. If you don't believe that market prices are good estimates, if you believe that the market has it wrong, you're pitting your knowledge or hunches against the combined knowledge of thousands or millions of other market participants. Everything that's known about a company, all its financials, all its future prospects, whether or not their last research panned out, whether or not they got that big contract, the market's expectation of future earnings, the perceived risks of either internal mistakes or competition, everything, along with some few investors who are guessing at outcomes of future events, is boiled down to the price of the stock right now. Every stock is at the right price given all the current information. The stuff that's not in the price are the things that are not yet known. In this example, orange juice is trading at 27 bucks and 57 cents on Friday. Not knowing that a couple market days later, there will be a fungicide scare in Reuters that will send the price of orange juice soaring to $32.22, 17% move over 2 days. Orange juice wasn't trading higher on Friday because no one anticipated the fungicide scare. But once it's known, markets incorporate the information very quickly. Same is true in stocks. In February of 2013, Berkshire Hathaway, Warren Buffett's company, made an offer that was accepted to buy Heinz for $72.50. Before the offer was made, Heinz was very boring, both in terms of its price, right around 60 bucks, and in terms of its trading volume. Look to the left of that huge spike in that lower chart. The point is that news travels fast and prices adjust to important news quickly. You see it all play out in a moment. Lots of heavy trading, buying and selling, and the price moves up 20% and then settles at that level until the deal closes. When new information is available, prices adjust quickly. Trying to figure out what will happen next is impossible for sure. But it also adds a tremendous amount of stress and anxiety. Some research has suggested that given the human proclivity to make mistakes, our constant plan changes actually hurt our performance. And this is precisely what that Dalbar study tells us. This is what we're talking about when we discuss the happiness dividend. Not only do I think we can improve investment outcomes, I think we can be happier while we do it by eliminating the stress and anxiety over the impossible task of trying to beat the market. We saw earlier that when you take the top 25% of managers in one period, then about 1/4 of those will be in the top quarter the next period. You won't be able to tell which ones, so don't try. But it's also important to understand that a large portion of the managers that failed to beat the benchmarks also failed to survive at all. They're either being gobbled up by another manager or simply liquidated and returning capital to shareholders. Now, they don't do that if they're successful, forcing them to reinvest their money elsewhere. Remember, these are the professionals whose funds are closing and failing to beat the benchmarks. So I've got to ask, where is the value in trying to outsmart the markets? If markets are efficient, and if they store the collective knowledge of all investors, what can you possibly gain by trying to outthink it? If you can't beat them, and you can't, join them. The easiest, and I believe the most intelligent thing you can do is to simply buy everything and avoid making any specific timing and selection decisions. Think about it this way. We all buy tires. If we own all the tire manufacturers and one of the tire manufacturing companies goes under, we all have to buy tires from the remaining tire companies. Same goes for banks, right? We all have bank accounts. If one bank goes under, that bank's customers will have to move their money to a different bank. If we own them all and one fails, the rest benefit from the reduced competition. The consumption of the good or service is the thing that counts. The end demand is the thing that counts, not whether this company or that company will serve the end demand better. As long as there are an increasing number of people with increasing means of purchase, which there will be an increasing demand, and increasing demand will lift the whole market, regardless of which companies are lifted more or less, which is completely unpredictable anyway. Investing in the whole thing looks something like this. This allocation represents all the stock and bond investments available to us on any market in the world. I call it the global all-asset portfolio, and it's made up of 18% U.S. stocks, 24% U.S. bonds, 25% international stocks, 33% international bonds. A couple quick things that might surprise some of you. First, bond markets are quite a bit larger than stock markets. And second, the international opportunity set is larger than the U.S. opportunity set. What you see here can be your default starting point for your asset allocation. If you can buy everything, this is really close to what it would look like. Any decision that wavers outside of this breakdown is a statement that somehow the world has it wrong and that you know something better. Anyone that makes such a statement can be proven right or wrong, but there's no way to know in advance who will end up where. The baseline allocation you see here is roughly 43% stocks of all sizes from all countries and 57% bonds of all types from many places. If you know something about investing, this might strike you as mildly conservative. In the US, when we speak of a balanced portfolio, we're talking about a 60% stock, 40% bond portfolio. And if we're talking growth or aggressive, there can be substantially more equity exposure involved. So let's use the global asset portfolio as our starting point and see where an individual might end up. Depending on your financial planning needs, one can simply tilt towards more or less stock market exposure. More stock exposure means more zigs and zags. Less stock market exposure means fewer zigs and zags, without changing the balance between the pieces. These four portfolios represent the dialing up and dialing down of risk levels without changing allocations between the different kinds of stocks or between the different kinds of bonds. I'll be on the slide for a bit. Feel free to take some notes on these allocations. They're great starting points. If our core global asset portfolio starts with 43% stock exposure, and let's say we just subtract 25% of that stock exposure to create a conservative portfolio with only 18% stock exposure, the remaining 82% bonds. Or, depending on how aggressive you want to go, you could add 25 or maybe 50%, or honestly anywhere in between, to your stock exposure and end up certainly with more volatility and also a higher probability of improved returns over your investment lifetime, though any short-term period would be completely unpredictable. We can simply select one of these risk levels appropriate to our plan and circumstances and calmly invest in it, knowing that we have the universe of opportunities. And while some of our portfolio may lose favor with other market participants, another part of our portfolios will be gaining favor. In this way, we nullify the market's popularity contest. Okay, once you have your asset allocation, there's only really three things you need to do. You need to select your investments. You need to actually put your money to work in those investments, and then you need to manage those investments over time. But just before we get to that, I want to talk about a very important law of economics in investing. I want to talk about the law of diminishing returns. You see, I love peanut butter cups. After Halloween, I bribe my kids every single year to give me all their peanut butter cups, and I usually eat them within 2-3 days. Here's the thing. I'll eat 2 packages of peanut butter cups, and I'll be completely, stupendously happy. And then I might go on to eat a couple, eat another package, 2 more cups, and I'll still love them. They're great. I'll eat 2 more. The joy in each one kind of goes down a little bit. And if I eat a couple more, I kind of actually start to feel dull, maybe a little sick. And if I'm feeling, frisky and eat a couple more, I think that's a 10. I start to really feel physically disgusting and sick. And if just out of pure habit or some misconstrued addictive belief that I can get back to the joy of that first 2. If I eat 2 more, I think that total comes to 12. There's no more joy at all. I sort of fall into a deep emotional self-loathing. And the more and more and more of this thing that I truly love ends up hurting me. The law of diminishing returns states, when one input in the production of a specific outcome is increased, while all other inputs are held constant, a point will be reached where each new addition of the input yields smaller, diminishing increases in output. My first peanut butter cups created utter joy. Next ones, still joyful, a little less so. The next ones, not really joyful at all. And beyond that, it goes into reverse. And each additional input actually reduces my happiness. What's this have to do with investing? The plan-based asset allocation decision, just picking which one of these is the right choice for your plan, is the highest order decision in investing and will add the most to your long-term financial success. Any and every decision made after this decision will add an ever-diminishing benefit. And if you get it wrong, it may also create a negative outcome. So be very, very careful beyond this decision. Yes, you can optimize for a better portfolio, but it takes a lot more effort for a little bit more benefit. So let's move on to some tool selection conversation. Guided by these principles, and with a wealth of research about the financial markets, how should we think about investing? A particular view of market pricing will shape how you invest. And there are basically three approaches. We can do traditional management, we can index, or we can follow what I call academic investing. So let's look at those three. The dominant or traditional investment approach assumes that prices are not accurate. This leads to an attempt to predict the future, which incurs higher costs and risk. We've already looked at the main problem that people encounter when they follow a predictive investment approach. Let's see if professional investment managers can do a better job at traditional investing. Consider the illustration of how conventional managers invest. This box represents the entire stock market universe, and the dots are individual stocks. A manager buys a handful of securities expected to do well in the future and sells securities expected to not perform well. Note that this type of manager starts with nothing and finds a reason to pick one stock over another. The manager's selection criteria are based on whether the stock is considered overpriced or underpriced. But choosing only a few stocks in the market often results in poor diversification and higher risk. Equally important, the manager's frequent buying and selling results in high costs as the portfolio is turned over many times. Manager research shows that traditional investing has low odds of success. Over the 10-year period ending in 2013, only 19% of stock managers and 15% of bond managers survived and outperformed their benchmarks. Said another way, 81% of stock managers and 85% of the bond managers who started the 10-year period underperformed their market index. Half of the stock and bond managers did not even survive the 10-year period. Should we be surprised by this poor record of performance? Not really. It makes sense if market prices are the best estimate of actual value. Manager underperformance is not necessarily due to a lack of knowledge or expertise. In fact, many professional investment managers are very bright, educated, hardworking. The problem is that this high level of expertise and motivation results in intense market competition between them and other bright, educated, hardworking managers, which drives prices to fair value. The more managers competing for a price advantage, the more efficient the market becomes. With the advent of computing power and data availability, academic research has documented the poor outcomes of most traditional managers. This is one reason for the rise in the popularity of another investment approach. Indexing. Indexing offers a number of investment benefits over a conventional approach. Broad-based indices offer better diversification, have lower fees, and follow a more transparent investment process, which means investors have a clearer idea of what they're getting. The problem with indexing is that the commercial index provider determines the stock or bonds held in the portfolio. The firm publishes a list, usually annually or semi-annually, containing all the stocks composing that index or benchmark. The manager attempts to closely track the benchmark, but rigid construction works against the strategy. Most index managers are judged by their ability to closely track the respective index. They don't want to underperform, but they don't want to outperform either. The main problems with this approach are loss of control, trading disadvantage, and style drift. So we're going to take a look at each of these individually. Loss of control. An index manager does not start with the whole market, but with a list of stocks published by the index provider. The manager holds a basket of stocks in an attempt to match or closely replicate that list. The investment strategy is defined by a commercial index provider, and the manager has no control over what that fund holds. This creates a trading disadvantage. When the new list is released, managers must buy and sell at the same time to keep their portfolios and returns in line with the index. This updating process is known as the index reconstitution. Everyone knows what the index fund is holding and when the index manager will rebalance. The index provider has shown the cards to the marketplace, and the index fund manager will have to trade with urgency along with other managers who follow the index. This puts the managers at a trading disadvantage, which usually results in higher costs borne by investors. Additionally, there's this thing called style drift. Security prices change every day to reflect the market's latest expectations, but indices rebalance only once or twice a year. As new information is incorporated into market prices and securities start to exhibit different characteristics, the index portfolio can move away from its target universe or asset class. This is referred to as style drift, and it happens to indices between reconstitution dates every time, leaving investors holding stocks they may not want to own. The third approach is informed by financial science and the view that market prices reflect all available information. We also believe that different securities can have different expected returns. Guided by this perspective, this approach looks to academic research to gain insight into the factors that drive those expected returns, then integrates this knowledge into strategies designed and implemented to add value in a competitive marketplace. Rather than viewing the market universe in terms of individual stocks and bonds, an investment manager can define the market along the dimensions of expected returns to identify broader areas or groups that have similar relevant characteristics. This approach relies on academic research and internal testing to identify factors which point to differences in expected returns. Research shows that some market areas have higher expected returns than others. In the stock market, the three most well-proven factors are size, where small cap outperforms large cap, relative price, where value does better than growth, and profitability, where high-profit companies outperform low-profit companies, which kind of makes sense. In the bond market, these factors are credit quality and term. The return differences between stocks and bonds can be considerably large. So can the return differences among a group of stocks or bonds. Factor investing is not about short-term performance. To be considered a factor, it must make sense, be backed by data over many and long periods of time, and be consistent across markets. Also, it's got to be capturable in a diversified, cost-effective portfolio. If there are systematic differences in expected returns and research has identified them, how can that insight be applied to practical investing? We select broadly diversified portfolios as many securities as possible that emphasize areas offering the potential for higher expected return. The strategies can emphasize securities with higher expected returns by overweighting them compared to their market cap weight, and underweighting those that were expecting a lower return. One way to visualize overweighting is to think about a tilted ice cube tray with sections that are shallower and deeper. In a portfolio, each section holds many stocks that compose a market area, and those with greater return potential are overweighted, just like the dark green on this chart, and just like a large ice cube. In a factors-based approach, capturing returns does not involve predicting which stocks, bonds, or market areas are going to outperform in the future. Rather, the goal is to hold well-diversified portfolios that emphasize dimensions of higher expected returns and have low turnover, and therefore lower internal costs. Obviously, I'm a huge fan of the most broadly allocated portfolios possible, and I'm recommending portfolio tools that are based on the academic research into market efficiency and the specific factors of return, size, value, and profitability. In a pinch, a very broad index, like the ACWI we mentioned in an earlier slide, that's the All Country World Index, will suffice for global equities. But I would prefer an emphasis on the factors research has shown to work over time. Now, let's consider how to bring it all together in practical investment strategy. First, you have to get the money into the portfolios. Many investors utilize, and we absolutely recommend, an investment strategy called dollar cost averaging. With dollar cost averaging, rather than investing a single lump sum, you invest smaller amounts of money at regular intervals, no matter how the market's performing. Your goal is to reduce the overall volatility of your portfolio by purchasing more shares when the price is low and fewer shares when the price is high. Note that regular dollar cost averaging squares perfectly with how most of us earn our money in the form of a regular paycheck. Although dollar cost averaging can't guarantee you a profit or avoid a loss today, a regular fixed dollar investment may result in a lower average price per share over time, assuming you continue to invest through all types of markets. It works, but don't overcommit to it. You should consider your financial ability to make ongoing purchases, regardless of price fluctuations. For example, let's say you decide to invest $3 each month towards your child's college education. Because you invest the same amount each month, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, you'll find that your average cost per share is actually less than the average market price per share over the time that you invested. If you're currently contributing automatically to a 401k plan at work, you're actually already practicing dollar cost averaging. Dollar cost averaging can also work to break up the entry point for any larger sums of money you may receive, like a large gift or inheritance, though this is a specific issue that's best handled individually based on your plan and circumstances. No matter what we do, our portfolio will probably every year become out of balance. Either something we own will do horribly, giving us the opportunity to rebalance and buy more of it at reduced prices, or as above, something will do well and we'll need to rebalance out of it. In this case, we see that the stock portions of our growth portfolio have done well, and the blue and orange slices have expanded to make a larger piece of our portfolio allocations than we intend. When it's time to rebalance, we're going to sell 4 of the blue slice and 6 of the orange slice, returning the stock exposure to our original amounts. And we're going to buy 7 of the yellow and 3 of the gray, returning our bond exposure to our intended plan allocations. The process of rebalancing is the process of putting the portfolio back into balance that our well-designed financial plans called for. Notice we're selling the thing that's done well, we're selling high, and buying the thing that's done relatively less well, we're buying low. It looks something like this. The process is the art of selling those assets that have outperformed in the short term and buying those assets that have underperformed in the short term. In essence, it's a forced dollar cost average. It's a very powerful additive to a portfolio returns over long terms. Such a plan involves the continuous investment in securities regardless of fluctuation in price levels of such securities, and investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets, though I am the firm belief that patient rebalancing, instead of selling and hiding, is the right behavior in anticipation of a recovery and a renewed expansion. Design and implementation require careful balancing of trade-offs under which the returns are pursued. Research can provide abundant data on investment factors. Without considering the trade-offs, however, what may look good on paper and in the data won't be as compelling in practice. Here's a simple example to help showcase the importance of trade-offs. Consider 2 investment opportunities, A and B. They've got the same expected return, but capturing that return occurs under different conditions. Approach A involves patient and flexible trading, resulting in lower turnover and better diversification. Approach B requires urgent trading and offers less flexibility, resulting in higher turnover and lower diversification. One approach incurs lower costs, the other approach incurs higher costs. Which approach makes sense? Given the same expected return, approach A enables you to capture more of the return identified in the research. An investment manager can apply this framework to the design of its strategies and also consider these kinds of trade-offs in real time when executing in dynamic, complex markets. Remaining patient and flexible leads to lower implementation costs and helps with other investment considerations like diversification. The result is potentially higher net performance. So, to have a better investment experience, people should focus on things they can control. From part 1, before you invest, we talked about create a financial plan tailored to your specific needs and goals. Understand your trade-offs. Fund your emergency fund. Protect your family from the big risks, health, injury, and death. Pay off high-yield debt. And start saving and investing as much as you can. All things you can control. Today, we talked about some risk-adjusted form of the global all asset portfolio makes the most sense. Remember the peanut butter cups. The more I ate, the less I enjoyed them. In investing, once you figure out the right asset allocation, tweaking your portfolio further requires more and more effort for less and less benefit. Pick managers or indices or factors with very broad holdings in the US and around the world, and then dollar cost average on a regular basis and rebalance, at least annually. If you have questions, don't hesitate to ask someone for help. You have all of our social media contact info, and my email address is going to be at the end of this presentation. Now, I've said this before, but I'm going to repeat it. 99% of investors, and honestly almost all financial news and commentary, consider the daily flow of market data and economic information to be an important part of the investment decision-making process. The financial science simply does not support this position. Decisions based on today's news are like the 10th or 11th peanut butter cup. They probably do more harm than good. Financial news is a distraction. It causes stress and anxiety, and I think in the end actually hurts our outcomes more than it helps. So work on those soft skills: faith, patience, and discipline. There's going to be tough times. No matter how you invest, you will be wrong at some point. You must maintain your faith in the plan you've created and believe there will be improvement. Patience to wait for the improvement to happen, and discipline to stay invested and keep investing when everyone around you is panicking and running for the exits. So I want to say thank you very much for attending Investing Everything You Need to Know webinar. Hope you'll join us for After You Invest on June 26th, where we're going to talk about the psychological hurdles you will face given this new path of investing and describe how you can overcome them through humbly admitting how little we know. You can write the date down now, again, June 26th. Of course, we'll send you an invitation as well. As always, if you think this content is valuable, help me spread the word. Follow us on Twitter, tweet about us, like us on Facebook, and post some of our events. Become part of the conversation. Tell your friends to subscribe on the website, and we'll invite them as well. The best part of success and getting on a low anxiety plan is actually helping someone else find success and reduce their anxiety as well. Thank you again for spending as much time with us today. And just as a quick reminder, we start these and end these this way. This is general information. This isn't specific advice. If you have questions when this is all over, ask them. You found us online. You know where to find us again.